Well, on a 6 month view onwards, we've got a very high weighting in cash. Amongst equities, we've got a large underweight in emerging markets. What we've got in developed market equities is really large overweights in the low beta stocks, low beta indices of the world. So things like the S&P, we'd avoid the MIB, for example. We've got a lot in sovereign bonds, not in EM, but in developed markets, and then really the overweights are in treasuries. I mean, I think in a world in which the Fed are tightening policy, you can expect a continued flattening of the yield curve, and for 10-year treasuries to outperform and do well relative to other developed market sovereigns. Having said that, there's a big question mark over how low yields will go in a recession scenario, given that you've got emerging markets as a natural seller of treasuries. In commodities, we quite like gold, we like silver. As the Fed eventually move back to looser monetary policy, those kind of asset prices should perform very well. And we've got very little in credit. We've had zero weights in credit, high yield credit in emerging market in the Eurozone and in the US for a long time. A little bit in high grade, but we would look to be buying credit with both hands in probably 6 to 12 months, something like that, once this bear market is drawing to an end.